Let's focus on gold. Prices are off their record highs. To discuss this and more, and the demand trends as well, we're joined by Mr. Suvankar Sen, the MD and CEO at Senco Gold and Diamonds. Hi, Suvankar. Good morning. Good to see you in. Thanks a lot for joining in. Well, gold prices have cooled off a little bit, which may not be such a bad thing, right? Because maybe your clients were finding it a little bit unaffordable. Tell us, how are the demand trends, and cooling off of gold may not be such a bad, aspect for you?
So if we look at the quarter and look at the numbers for the particular quarter one of this financial year, the numbers are looking positive. There is about a 20% growth in terms of value that we are seeing as we are ending the quarter. However, it's been the April month, which has been a much more stronger month, where we have seen a much higher growth compared to the last year's April. May was somewhat average, but the gold prices started moving up more post, I would say, mid of April. And if we look at the month of June, I think that it's been a little bit of a, under stress in terms of footfalls and in terms of the consumer traction, because there haven't been that many weddings this summer. But all in all, in terms of value, if we look at it, yes, we are seeing a robust growth. And the most positive thing that has happened in this particular quarter has been that the probability and the chances of diamond jewelry that have got sold, the consumer interest towards diamonds have been much higher compared to what we had seen in the last year's Q1 or Q2. And the growth that we see in diamonds is much higher than the normal 20% growth that we're talking about, which will hopefully have a much better impact and and the results in terms of profitability for the company could be on a much better side because of the higher sales and the ratios and the stud ratios of diamonds. So yes, it's been a mixed quarter. The footfalls in the last month has been a little under stress because of the high gold price. And now that the gold prices have come down a little bit from the all-time highs, I think consumers are just waiting and watching. The moment they see that, yes, the gold prices have found a stability and it looks as if things will not be so much volatile, I think that they will be kind of getting back into the picture and start buying in a strong way again.
So cooling off of gold may not be such a bad thing. Cut that, Suvankar. A quick couple of questions. I think most of your gold is hedged, right? 80-85%?
Yes, we usually hedge 80-85%, but this particular quarter, just to inform you, that our hedging has been in the range of 55 to 60% because the gold has been on an upward trend and the geopolitical tensions were very much on the higher side. So, to protect the liquidity, the margins, our hedging has been closer to 60% particular this quarter.
Okay. All right. Got that. Suvankar, so give us a sense of, your estimates for the year. When we spoke after the fourth quarter, you said about maybe high teens growth for this year would be possible, maybe 18-19%. Given that now gold prices are cooling off, and if they continue to be on this trajectory, would you be confident of doing even better than that? I mean, what is the overall sales estimate you're working with? Same-store sales growth you're working with?
So the Q1 numbers, are looking positive. The value growth, as we said, that is 20% plus. So therefore, I think that, yes, as we go through the Q1, it looks as if the 20% number for the whole year is possible. But we need to be very, very, cautious in terms of looking at Q2 also. Any kind of incidents or any kind of volatility in gold price, whether that gets impacted or not. But till now, it looks like value-wise, Q1 growth of 20% and the annual growth of 20% looks very much possible.
Okay, so 20% growth does look very possible. What is your mix in terms of studded and non-studded right now? And what's happening on the studded jewelry side of the business? Because that's also where there's a lot of change going on with diamond prices. I mean, earlier they were correcting natural diamond prices and lab-grown was growing. So just give us a sense of the studded business as well.
So the studded business, what the good thing that we've seen this particular quarter is that our traction towards diamond jewelry has been on the higher side. So for last year, our overall stud ratio was about 10.9%. But if you look at this particular quarter, our stud ratio is above 11%. So that gives a very, strong and positive thought in the mind and in terms of the results also, since the margins from the diamond jewelry is comparatively higher than in gold jewelry. So this will give a boost to the margins as well. And I think that because of the high gold price, the consumers are also looking at lower caratage option at 14 carat, 18 carat, studded with diamonds. So I see that the growth rate of diamond jewelry has been higher than that of the normal plain gold jewelry. So that's a good sign overall on the margin side.
Suvankar, just a quick question. Since the proportion of gold that was hedged was lower, that will have a positive effect, right, in the near term?
Yes, since the hedging has been on the lower side, we are expecting that there will be a positive effect for that in the near term. Yes, you're right.
And just to go back to the studded piece, since you're saying that there is more traction here, we're only talking about natural, right? Because you do have a separate vertical, I believe.
See,
for lab grown.
Even the while we have about 4 to 5 stores for our lab grown diamond stores, and there also the growth rate, because the base is very small, the growth rate will look positive, but that is nothing substantial that will be impacting much on the overall scheme of things. But the fact that natural diamonds have also grown in a larger manner, so that will give a boost to the natural diamond business and the overall margins as well.
All right. Suvankar, good speaking with you. Thank you very much. Golden conversation. Appreciate it, as always, here on CNBC. Well.